Welcome back to Mercury Investors Trading Program, Chapter 3. In this chapter, Abdul is going to be talking about trend lines, support, and resistance levels. I hope you all enjoy.
So in this video, you'll learn how to spot and how to use a trend line, how to identify support and resistance, and you'll learn how to identify key levels. You also know how to utilize these in your trading, and we'll show you how to merge these with price action and what you learned in chapter 2 to create the start of your own trading strategy. So what are support and resistance? Well, in as few words as possible, they're seen as floors and ceilings in the market. Support and resistance levels are seen as turning points for price that seems to reoccur. If price is falling but always seems to reverse at the same level, then that level would be known as support. And if price is rising but always seems to reverse and drop at the same level, that level would be known as resistance. So how do you identify support and resistance? Well, identifying support and resistance is easy. Like I said, what you're looking for is a level that has numerous turning points. If price is already above this level, it is support, and if price is already below this level, it becomes resistance. Here's an example. So here you have a nice resistance support level at 1.2517 on pound US dollar, and here you can see it's support here. It pushes up once, creates a double bottom, pushes up twice. Nice support level, holds nicely there. And then it comes down, tests this as support, tries to break it, pushes up. Then finally does break it and comes back, tests it as resistance here. So at this point here, it's resistance. And then it pushes down, tests it as resistance, breaks, tests it as support, breaks, tests it as resistance, drops, fails to break here, or actually does break, tests it as support, and then breaks, tests it as resistance, tests it as resistance, tests it as resistance, and comes tumbling down. At this point, you see another double top. So here you have a double bottom, there you have a double top. So you can start to see what we told you in chapter 2 coming into effect already. So what if support or resistance is broken? Like I showed you in the previous slide, it doesn't always hold. It usually does, but doesn't always. And when it does break, then you just see it turn into resistance. If it's support and it breaks, it turns into resistance. If it's resistance and breaks, it turns into support. So here's an example. It's nice. It's support here. It's support here. It comes back. It's support here. It's support here. It breaks. Resistance here. It breaks. Support. Support. Push. So that's quite a nice example on pound dollar again. That's a different level to the one I just showed you. So what are bank and key levels? Bank and key levels are simply support and resistance levels that fall on round numbers. For example, Great British Pound US dollar from 1.25 in 250 pip intervals. That's how you find your support or resistance, your bank level for that. So here you have examples of what they would be: 1.275, 1.3, 1.325. Euro US dollar, again, from 1.1 in 250 pip intervals, 1.21250, 1.15, 1.175. Euro GBP from 0.85 in 250 pip intervals again, 0.875, 0.9, 0.9250. So on to trend lines. Trend lines are probably the best confluence to use, as they show directions clearer than anything else. They show where the momentum is, and they can identify where the price will slow down and reverse. Sometimes they do break before making the reversal, but it doesn't make the trend line invalid. At that point, once the reversal is made, you just need to adjust it again, and it should be valid again. The third touch of a trend line is break or bounce. Usually it does bounce. I believe it was 80% of the time. And when it does bounce on the third touch, it validates the trend line. So it's best to trade off the third touch. So how do you spot a trend line? Well, trend lines should just be drawn from an outstanding wick, often at the top or bottom of a move. And then you look for a second turning point, which confirms the trend line. There can also often be a third point that fits perfectly, or you can choose to trade off that. So here's an example of actually drawing a trend line, one that I made myself. So here you have your outstanding points here on pound dollar here. You want to take your tool, you want to catch it right on the end of the wick and then pull it to the next low point, the next turning point. And then you see here, once you have it adjusted perfectly to fit on the wick, as it is now, you can see that third touch causes a bullish move. And I'm about to show you how far that actually moves. I think it was about 200 pips from the touch of the trend line. So as I'm just showing you here, there's the direction of the third touch, and it moves for about 200 pips, yeah, to the highs. So that's quite a nice move off the trend line. And yeah, you see, just by adjusting that again, you'd make your trend line valid again. So in terms of actually trading off of them, here's a few examples I found. So here you have the start of the trend line. This first turning point, here, price is coming down, then pushes up from that. So that's the start of your trend line. And the price comes down and touches this one. That would have been your original second point, but it actually slightly breaks here on that touch. So you would have adjusted it to be that, for that to be the second touch. And then you get a push up, a nice push up there. And when price comes back and tests that, it kind of fits perfectly, but does slightly need adjusting in this case. And you get a nice move up that had a nice potential. I think it was 4 or 5 to 1 risk reward. And here's another example on the same pair. Whilst this is all happening, you have your first touch, a big turning point, your second touch, your third touch, which fits perfectly. Like I said, sometimes they'll break a little bit and sometimes they'll fit perfectly with the trend line. And in this case, it does fit perfectly, and you get a nice move to the downside. So how do you use these in your trading? Well, it's really important that you use trend lines with other confluences as opposed to independently. If you combine trend lines with resistance or support levels, you'll see a much bigger move and a much more profitable trade. Using them together will also reduce the likeliness of your trade actually being a loser. If you combine these with the candle formations and chart formations that we identified previously, you'll get the best results, as it'll be a high percentage trade. So here's a little example that I have for you, if I can get that up now. So here you have that inverse head and shoulders. So that's your first confluence. You're at this point done, coming down here. That's your first confluence, inverse head and shoulders. And then you have a morning star candle formation there. And then you actually have the third touch of a trend line coming on the second morning star candle formation. And it all meets together with the support level. So once coming together, there was no real doubt that this trade was going to be profitable at this point, because you have that trend line, you have your inverse head and shoulders on a 4-hour chart as well. You have your morning star, you have all your confluences, and you're starting to build up a little strategy here. And once they came together, they made a nice bullish push up, and I think it was 3 or 4 to 1 risk reward, which is quite nice. So what happens if a trend line becomes invalid anymore? So once a trend line breaks and becomes invalid, more often than not, you'll see price retracing back to touch the trend line, the outside of the trend line that is, before making the big move in the opposite direction. When this happens, more often than not, you'll see signs that confirm that the trend line is no longer valid with the price action or the technicals. The price doesn't always retrace all the way back, but there's usually a small retracement for those who are looking for entry. Usually when a trend line breaks, there'll be a huge candle showing the strength of the break, like here. So you have your nice little trend line here, your first touch, your second touch, which would have been adjusted after this one, and your third touch here. You see price never made another high here. So this is after the second touch, you're looking for price to really come up and make another high here. So that's your first sign that this could actually break when it doesn't. Then you got this doji candle here, which suggests indecision in the market, prices deciding what to do. You have a nice little push up and then a really, really, really strong break here. At this point, because the strength of the break and the close of the 4 hour candle, you'll see price is likely to just drop from there. So what do? You wait for price to come back to this level here. As you can see, this level here, you have some outstanding wicks there, outstanding wicks. You get a cluster, you get some outstanding wicks, some turning points here, turning points there, turning points there, turning points there, rejections, turning points, turning point. So it's a nice support turn resistance level at this point. So price breaks through the trend line and the resistance level together, comes back to the resistance level, and then pushes lower from there for a nice 3-to-1 risk reward ratio. And that would actually be your entry around this point here. Some more aggressive traders would have probably looked for a slightly higher push up to retouch the trend line, but this trend line is quite steep, so it's unlikely that would have happened. And you want to place your stop loss just inside the trend line, just in case it does go into a bit of drawdown. You have a bit of space to maneuver. So to conclude, in chapter 4, we'll be going over multi-time frame analysis, how you use it and why you should use it. We appreciate you for watching. Thank you. Hope to see you in chapter 4.